week, brand new episode. We are still in the month of January, and so everything is new. And to begin anew, one needs to plan. That is what budgeting is all about, in individual lives and in corporate settings. Last episode was the second installment of our focus on the Federal Government Budget 2022 and the Finance Act 2021. Mr. Albert Folorinshaw, a tax consultant, was our guide. We concluded that episode by serving you an appetite whetter from our next guest, Mr. Matthew Gbonjubola, Group Lead, Special Tax Operations Group at the FIRS. We sat down with Mr. Gbonjubola to get the perspectives of the tax collector on the issues at hand. Mr. Gbonjubola, thank you for joining us on Tax Matters.
Thank you very much.
Sir, President Muhammadu Buhari assented to both the Federal Government Budget 2022 and the Finance Act 2021 on Friday, 31st December 2021. And the Honorable Federal Minister of Finance, Budget and National Plan has since unfolded the details of the Budget and the Finance Act 2021. Now, you are the Group Lead of Special Tax Operations Group at the FIRS. This program is Tax Matters, so we'll be looking at the tax components of the Finance Act 2021 and the Federal Government Budget 2022. The Finance Act 2021 has amended 13 tax laws. Could you please give us a general overview of the provisions of this Finance Act 2021?
You are giving me a Cambridge exam now. I'll try, but let me start by saying that the FIRS has finalized or published a summary of the major issues arising from the Finance Act. That should hit the airwaves in the next couple of days. In respect of companies income tax, there are a number of changes that has come. For example, the minimum tax rate is reduced to 0.25% for 2 years, and taxpayers can choose any 2 years between 2019 and 2021. So that has been made very clear. We have under CETA also, we have also provided that where there is a tax dispute, the taxpayer is required to pay the tax that is not in dispute. And let me explain that. It is possible for FIRS to assess somebody to say, come and pay additional tax of 1 million naira. The person says, no, I'm not supposed to pay 1 million naira additional tax. I'm supposed to pay only 200,000. So what happens before is that the old 1 million is kept in abeyance until the case is resolved either in the courts. But now the law says, all right, go and pay the 200,000 you admit that you are owing, and then we can then go ahead and resolve the remaining 800,000 when the court is able to give us a judgment. So we have something like that. For FIRS Act, for example, I think the major changes that are coming there is the issue we have just discussed now to make it very clear that only the Federal Revenue Service is to collect and administer taxes on behalf of the federal government and the federation. For VAT, just making it clear that FIRS is able to collect VAT from non-resident business people that are providing services or goods to people in Nigeria. For NASENI, you see what is done is just to make it clear that FIRS is going to collect, and also for police trust fund to also make it happen. Like I said, we already have drawn up, we have finalized a sort of summary of the major changes in the Finance Act, which should be in the public domain in the next 1 or 2 days.
Now to some specifics. Capital gain tax of 10% has been imposed on disposal of shares above 100 million naira when the proceeds are not reinvested in the capital market. Do you want to enlighten our viewers on this?
Yes, thank you very much. Capital gain tax is payable when gains accrue on the disposal of chargeable assets. Before now, stocks and shares are exempt from capital gains tax. But based on government policy as enunciated by the Honorable Minister of Finance late last year, that there will be gradual rollback on some of the tax waivers that we have, because one of the problems that have plagued us is that we have so many tax waivers in our system, and the international community, the international finance groups, World Bank, IMF, OECD, and HIT have been very, very loud in bringing our attention onto the need for us to begin to rationalize our tax waivers, more so that our economy is not doing great and government is not having enough revenue to fund its activities. And as such, in order to also reduce the level of borrowings that we are having, which is becoming very huge, therefore government has decided to begin a gradual rollback of some of these tax waivers, and the starting point is the capital gains tax on stocks and shares.
All right. Now on the 10% excise duty on carbonated drinks. This is excise duty. I mean, presumably the purview of the NCS, that's the Nigeria Customs Service. Now, does FRS have any role to play in this?
I'm happy you have mentioned that it has to do with customs and excise, which is strictly within the purview of the Nigerian Customs Service. And so when you talk about a role as to the imposition of excise duties, FRS has no role. It is strictly within the Customs and also the Ministry of Finance and the National Assembly. Whether it has an effect, yes, it has an effect on tax, because excise duty, just like customs duty, is one of those expenses, business expenses, that are deductible before we arrive at taxable profits. And so when excise duty goes up, costs of production that is deductible for in arriving at taxable profit will also go up, which means that taxable profit will reduce, and ultimately the income tax that will be collected will also reduce proportionally. So that is the effect.
All right, so let's look at taxation of e-commerce, especially taxation of non-resident firms. Now, these measures look ambitious to us. I mean, how will it be to implement?
It is actually not ambitious. And it is not a brand new provision. I know that I've read one or two comments in the public media suggesting that it is a new tax, and it is actually not. The provision first came in 2019 by the Finance Act of 2019. We tweaked it in 2020 Finance Act. What we have done this year is to make it clearer and to also be certain, because one of the maxim of taxation, or canons of taxation, is clarity and certainty. And so what we have in the law now is to make it clear that we are an overseas company, that is a foreign company, a non-resident company in Nigeria, fulfills the various conditions to become taxable in Nigeria, particularly by having what we call significant economic presence. Then the service may have the option of assessing such a company to tax based on its turnover. What we have before required that such entity must file returns, and then we must go through the issue of assessment and whatever. And we also find out that that may be cumbersome to companies that do not have physical presence in Nigeria. And so therefore, it gives an option. That's okay, you don't want to do returns, you don't want to have auditor in Nigeria to get your account and all of that. then we could actually assess you based on turnover. And we already have that provision in Section 30 of CETA. So it's not a new provision. They're just bringing in this group of taxpayers, new taxpayers, to come under that provision.
So I also want to know the measures put in place.
As we speak, we already have enough measures to be able to enable such taxpayers to register, file returns, and to pay. We have various channels. For example, we have what they call the TaxPromax, which is our flagship tool for tax administration. And so a non-resident entity could log in into our FRS system through the TaxPromax, register, file returns, and pay. We are also working with CIAT. CIAT is an international tax organization in South America. We are providing what we call a DEC tool, that's a DEC tool, which also is primarily for non-resident entities, for them to fulfill their tax obligation, including VAT obligations. So we already have those measures. We have issued an information circular and guidelines that taxpayers in that category could use for the purposes of fulfilling their tax obligation. So we have measures. We have a completely different office where affairs of such companies are handled. We call it non-resident taxpayers office. It's in our office on Awolowo Road in Lagos, Ikoyi, Lagos. So we have already structures, both in terms of staff, in terms of tools, in terms of communication, and also in terms of the guidelines that will help the relevant taxpayers to comply with the law. So we are ready. We have all the structures on ground.
Thank you very much, sir. We'll be going on a short break, and when we return, we'll still be discussing the tax components of the Federal Government Budget 2022 and the Finance Act 2021.
Let's go taxing. Hand in hand, cheerfully. We go taxing as birds of a feather that flock around to make a living. With our signals drawn on the field, we go to pay our taxes cheerfully, knowing that our lives come to naught without us taxing together, to build our homestead, to mend our lives anew, to make our lives whole. Let's go taxing, hand in hand cheerfully, drawing our strength like a broom that breaks not, for taxing together makes us wholesome.
I'm a very busy man. My business involves a lot of traveling and I interface with lots and lots of people and organizations. Tax compliance used to be a big drag on my business. It was time consuming and very costly. But now, no more. Introducing the FIRS TaxPromax, the truly fully end-to-end tax administration solution for companies' income tax, value-added tax, petroleum profits tax, and all other tax types. For fast, efficient, and convenient end-to-end tax experience, log on to www.taxpromax.firs.gov.ng. TaxPromax has turned things around for me. It is fast, user-friendly, and cost-effective. FIRS, making tax administration as easy as ABC.
We are back, and we are still discussing the tax components of the Federal Government Budget 2022 and the Finance Act 2021. And our guest is still Mr. Gbonjubola, the Group Lead Special Tax Operations Group at the FIRS. Mr. Gbonjubola, welcome once again.
Thank you very much.
So there's also something on the FIRS appointing agents for VAT collection from non-resident companies. Do you want to speak on this, and also what are the measures put in place for this to be effectively implemented?
First of all, we need to explain what is the concept so that people will understand. FIRS does not use agents to collect tax. So I'm going to make that very clear. And of course, the Federal Revenue Service Establishment Act forbids that. that we cannot contract the collection of taxes to a third party. And now, so when we talk about appointing agent here, it's not appointing a firm or a company to act on behalf of FIRS to collect tax. I need to make that clear. Now, what it means here is that by definition under the law, a non-resident person for VAT purposes is not a taxable person, and as such cannot charge VAT, collect VAT from its own customers and remit. That is ordinarily what it means. Now, this provision came in to now enable FIRS to appoint such a non-resident company as its agent to collect taxes from its own customers and then remit the money to FIRS. So that is actually what that provision means, is to enable non-resident entities who ordinarily are not subject to our VAT law because they are not within the country, to now qualify them to be able to charge VAT when they transact businesses with Nigerian residents, and be able to collect that VAT from them and then pay to the Federal Revenue Service. So that is the whole concept of that agency, so that it's not as if FIRS is now using agents to collect taxes. No, absolutely not. It's not within that realm. So it's important that we lay that foundation. And now what we have done there is that we have the primary law now that enables us to do that. We are also on one-on-one engaging with specific non-resident merchants, the big ones that have platforms that Nigerian patronize, engaging them, educating them, and also getting their consent to act on our behalf, that when they provide goods or services to a Nigerian or to somebody in Nigeria, then they are able to include VAT in their own invoices, and then the customer pays the cost of the goods plus the VAT to that non-resident, and that non-resident now pays the VAT to the government. So that's exactly what we have done. So for that purposes, we have the law, we have the guidelines, and then we have, I mentioned earlier that we are working with SEAT to have a tool, and that tool is primarily for that purpose, that those entities don't have to come to Nigeria. They don't need to have a representative in Nigeria, but they can just sit in their offices wherever they are, anywhere in the world, log into FIRS, register for VAT, get TIN, that's tax identification number, file their returns periodically, and then pay into the relevant accounts of government. So that is all this, what the issue of appointing agents for VAT is all about. Number one, they are not local agents, and they are not going to collect taxes from Nigerian entities and then begin to act like tax agents as we used to know it. But they are going to be acting as representative of government to collect taxes from their own customers when they are issued their own invoices, and then so they can add that VAT to it and then pay that VAT to government.
On security lending, sir, what was the situation before on security lending, and what do we have now in the Finance Act 2021? We also want to know, why has this provision been considered necessary?
Thank you for that question, Amaka. Security lending is not a new provision. We had it in 2019 Finance Act. And it's just creating a new window of business for the stock, what to call the capital market. Before the 2019 intervention by way of the Finance Act, what happens is that people buy shares and then they keep it keep the share certificates somewhere in there and lock it up somewhere. It could be there for the next 10, 20, 30 years because the owner is just interested in investing in that company, be getting the yearly dividends, get scrip issues when the company declare one. But what we found out is that in other jurisdictions, they don't just keep share certificates and lock them up in lockers and wherever. There are some very brilliant capital market operators that could actually borrow somebody's stock, trade with it, make profits, return the stock back to the owner, and then we'll have created some economic activity around that. So that is actually the whole idea, to enable capital market operators who want to operate within that sphere of the market to be able to go and say, look, you have 1 million shares in X and Y company PLC, lend it to me. And then he goes to trade with it. He sells, buys, sells, buys, sells, buy over a period of time, and then comes back and say, oh, I have taken 1,000 shares of this company from you. Take your 1,000 shares back. Maybe there's something I need to give you. I mean, because you are also running a risk when you give your shares to somebody to trade with. So whatever we have agreed as what I should pay you for lending me that share, I'll pay you. And then the person who has done that trading also didn't go home empty-handed. So instead of allowing the stocks to just remain there, dormant, latent, doing nothing, somebody can promote economic activity by trading in it, and then returning the owner of the share doesn't suffer any loss. Even if there are dividends declared, it doesn't suffer any loss by way of those dividends. It will still get its own dividend. If there are scrip issues declared, it doesn't incur any loss because the guy who has borrowed the shares will refund everything, including any dividend or scrip issue. So that is the whole concept. Now, how does it affect the taxman? The provision we have in the law is to prevent multiple taxation of that same stream of income, so that when there is someone has lent out its shares, and the person who has borrowed the shares has traded with it and has made profit, such that the profit is not taxable in multiple hands. Otherwise, tax will erode the whole profit that will have arisen by the way of that economic transaction. So the provision you have in the law is to streamline the taxation to ensure that the tax is taken only at one point and not at multiple points. So it's actually a sort of relief for taxpayers who are in that category.
It seems like the Nigerian Police Trust Fund has finally been born. Which companies are liable to pay this Police Trust Fund levy?
Well, by the relevant section of that act, all companies operating in Nigeria are liable to pay the levy. It's 0.005% of net profit. So that is the rate, and it is all companies operating in Nigeria.
So another one is also this Naseni levy. Is the Naseni levy payable by all companies also?
No. The Naseni levy has identified group of taxpayers that are liable. Banks, entities in the aviation, engineering, and similar activities. So the law identified the group of companies that will be liable to Naseni levy, not all companies.
Not all. And
there's a minimum threshold also for Naseni in terms of revenue. So if you are a small company, you are exempt.
Interesting. And both the Nigerian Trust Fund levy and the Naseni will be collected or administered by the FR.
Yes, that's what the law says, and that is actually the clarity that came in the Finance Act 2021 to the effect that the Federal Revenue Service will be responsible to administer those levies.
Time, oh time. It is said that time is the greatest thief of all. We have to call it a day, which means that this interview with Mr. Matthew Gbonjubola will have to continue next episode. Join us for enlightenment and information on taxation. Do have a beautiful week ahead.